an introduction to the world of ETFs. For beginner and advanced investors, exchange-traded funds can be a terrific investment tool. Investors wishing to increase the diversity of their portfolios without having to put more time and effort into managing and allocating their investments have started to favor these well-known funds, which resemble mutual funds but move like stocks. In today's video, we are taking a deep dive explaining ETFs and the reason why you should really go for it. There are a number of great strategies, ways that can help you get more profits in your investments. So, it's going to be a very lucrative video especially for beginners, so keep watching and let's get started. But before we begin, if you're new here, make sure to subscribe to my channel and turn on notifications to never miss any updates. Let's start. What are ETFs? A group of securities known as an ETF is available for purchase or sale on a stock market by way of a brokerage firm. There is an ETF for almost every asset class under the sun, including conventional investments and so-called alternative assets like commodities or currencies. Investors have access to leverage, market shorting, and tax-free short-term capital gains thanks to innovative ETF structures. Consider ETFs as containers that carry a variety of securities, such as stocks and bonds. Due to the diverse assets that make up ETFs, they offer investors immediate diversification. An investor spreads their funds across a variety of investments when they buy a share of an ETF. As opposed to stocks, where you purchase shares of just one corporation, this is different. How do ETFs work? An ETF can be bought and sold during regular business hours on stock exchanges, much like stock in a company. Like a stock, an ETF has a ticker symbol, and during the trading day, it is simple to access intraday price information. Contrary to corporate stocks, the share count of ETFs can change daily as a result of the continual issuing of new shares and the redemption of existing shares. Because ETFs can continuously issue and redeem shares, their market prices are kept in line with the worth of the underlying securities. Despite being targeted towards individual investors, institutional investors are essential to maintaining the ETF's liquidity and tracking precision by purchasing and selling creation units, which are big blocks of ETF shares that may be exchanged for baskets of the underlying securities. When the ETF price diverges from the price of the underlying asset, institutions exploit the arbitrage mechanism provided by creation units to bring the price back into line with the value of the underlying asset. Diversification. When you purchase an ETF, you make a single transaction involving hundreds or even thousands of distinct assets. It immediately spreads your risk. An investor can quickly and simply create a portfolio that includes a variety of asset types and regions by using ETFs. Accessibility. You don't need a large sum of money to begin started with accessibility ETFs because they frequently offer extremely low minimum investments. With just a few hundred, you can begin assembling an ETF portfolio and add more as you go. Very economical. ETFs are economical on a number of levels. You would have to pay your broker a commission each time if you had to go out and purchase each of the 500 stocks that made up the S&P 500. These costs can really mount up and hurt your refund. Because you just have to pay one brokerage charge when purchasing all 500 shares at once with an ETF, creating a diversified portfolio is substantially less expensive. The fees levied by the provider of the ETF make up the second degree of cost effectiveness. These fees mostly pay for their overhead. ETF fees initially began off at attractive levels, but many ETF providers now have slashed their costs for investors. Some now charge nothing at all. How do you pick the best ETFs? Define your objectives. ETFs are a solid fit for many portfolios, if not the majority. Are you setting money down for a deposit? Do you have a nest egg? It is a good idea to establish your investment objectives first. Think about your investing horizon and risk tolerance as well. Define your standards. ETFs can be shortlisted in one of two ways, by using pre-made screens or by creating your own. You can select from a range of pre-made featured screens using the Screeners tool. Finding the top performers based on well-liked investment topics and ETF types, such as local, global, sector-specific, and others, is simple with this method. As an alternative, you can use filters to build and save your own unique screens. You can make these as basic or as complex as you'd like. ETFs comparison. After you've narrowed down your fund options, you can choose to compare up to 5 ETFs. This tool is excellent for analyzing and contrasting ETFs based on fund goals, performance, and holdings across different asset classes. Alright now, ETFs versus stocks. Stocks give investors a stake in a business. They are also referred to as equities. The more shares you buy, the greater ownership of a company you are displaying. You bear financial loss if the business does, because the value of your stock goes down. Not all businesses offer dividends, which are payments made by businesses to their shareholders, but many do. Alright, now let's talk about ETFs. ETFs include hundreds, if not thousands, of equities from businesses operating in different industries and sectors. You're looking at a basket of companies when you buy an ETF. Due to their extensive diversification, ETFs are typically seen as safer choices for long-term investing. Since your money is spread out over these hundreds or thousands of stocks, diversification shields your portfolio from any single market slump. Stocks have the potential to offer investors more returns than ETFs. In contrast to ETF investing, buying and selling stocks is a continuous dance including a number of variables, such as timing, market emotions, business news, environmental conditions, and economic and environmental issues that could all affect the price of shares. ETFs are superior for long-term investing. 100% of the time, if you're using low-cost, index-tracked passively managed ETFs, you don't run the danger of a complete loss if you own an ETF. ETF investors never outperform the index since ETFs are meant to mimic an index's performance. On the other hand, individual stocks have the potential to soar and produce enormous returns on your investment. But once more, it's virtually hard to foresee which stocks will increase in value over time. It's simple to try to predict which firm will become the next Apple or Amazon stock in hindsight, but only time will tell. Past results do not guarantee future results, as they say in the financial sector. So, if you liked the video so far, press like and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. Let's move on. Why should you invest in ETFs, and what would be the reason to go for it? Individual transactions. The number one reason is individual transactions. ETFs replicate the index holdings. ETFs can therefore monitor particular markets, geographic areas, or any other sector that an index can. Traditional index investing, on the other hand, necessitates that investors buy each security included in the stock index basket separately. The same varied range of holdings are essentially offered by investing in ETFs in a single transaction. Each ETF share can be thought of as a mini portfolio, or a collection of fractional stock shares. Investors won't have to place numerous orders and determine what a reasonable price would be for each of those orders because this streamlines the purchasing process. Liquidity. ETFs that focus on liquidity streamline the purchasing process without sacrificing liquidity. ETFs trade all day, just like equities do. Additionally, they trade regularly. The most popular ETF by volume is the SPDR S&P 500 ETF, or SPY, and on an average trading day, more than 100 million shares are traded. Due to this liquidity, investors can enter or exit positions as often as they like. Prices for ETFs are updated continuously throughout the trading day and can also be used to sell them short or on leverage. In other words, despite the fact that they provide investors significantly greater diversity, ETFs trade exactly like stocks on the stock market. ETF taxes. If you've done any research on ETFs, you've definitely come across the phrase tax-friendly investment. This is often true when compared to standard mutual funds. Compared to ETFs, mutual funds are often exchanged more frequently, and every transaction presents the possibility of capital gains taxes. Taxes on capital gains from mutual funds are normally accumulated and imposed on fund owners each year. ETFs, on the other hand, do not realize capital gains until the assets are sold. Therefore, an investor effectively has the option to decide when to impose ETF taxes on themselves. Investors must still pay taxes on dispersed ETF dividends. Derivatives. ETFs give people the flexibility to manage their risk by using instruments like options, swaps, and futures contracts. You will probably find an ETF with such versatility, whether you want to hedge your ETFs with calls and puts or play ETF volatility with option straddles. Be mindful that an ETF's holdings occasionally contain options and futures. Derivatives are frequently seen in leveraged and inverse ETFs, although they are uncommon in passive index ETFs. Checking an ETF's holdings before including it in your portfolio is always a smart idea so you can fully grasp the impact the ETF will have on your trading approach and risk exposure. Passive management. Many ETFs are passively managed. However, some are actively traded. ETFs that mimic an index or benchmark without trying to outperform it are called passive ETFs, although that can happen on occasion. In contrast to an aggressively managed mutual fund that aims to surpass its underlying benchmark, the ETF just requires minimal modifications. Due to this distinction, ETFs' risk is comparatively lower and their management costs are lower. You get immediate dividends. The majority of ETFs pay dividends just like stocks would. A dividend payment will be deposited into your brokerage account every quarter. The timeframes may change in the case of conventional mutual funds. Instead of quarterly payments, several mutual funds pay out annual distributions. Lastly, an ETF is a superior choice for investors for many different uses because it comes with some tax benefits, low commissions, and simple trading. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you will be notified of every update. Also, don't forget to check the links in the video description. And while you're here, click to watch one of these two videos appearing on your screen right now. I'll see you there. Take care and stay tuned.